that glass down for a second. We need to perform surgery. We are entering the realm of component accounting. This is where the accountants stop being historians and start acting like biologists dissecting a frog. In the old days, you bought a factory, you wrote its cost in the ledger at 10 million, and you went to play golf. Simple, beautiful. But the IASB decided that was too easy. Now, under IAS 16, they look at your factory and say, well, actually, is not the factory just a collection of a roof, some elevators, and some bricks? And do not they all die at different speeds? Suddenly, your one asset line item turns into 50. You're not depreciating a building anymore. You're depreciating a roof, lifts, boiler, and carpet. It turns your fixed asset register into a database so large it crashes Excel. It's pedantic, time-consuming, and deeply irritating. Think of yourself. You are one unit of human being. If I were to depreciate you, and believe me, after this week you are depreciating fast, I might say your useful life is 80 years. But that's a lie, isn't it? Because you are not one solid block of marble. You are a collection of parts that wear out at wildly different rates. The skeleton, like structure, solid, lasts the full 80 years. The knees, like machinery. If you jog, these are gone by 50. The liver, like filtration system. Given how much we drink in this job, this needs replacing by 45. The hair, like fixtures and fittings, depreciated to 0 by age 35. If I depreciated your entire body over 80 years, I would be ignoring the fact that I need to buy you a new liver in year 45. When year 45 hits, I would have a liver failure expense that destroys my profit and loss because I did not plan for it. Component accounting is just admitting that while your bones might make it to the end, some other organ is living on borrowed time. Here's the technical reality of IAS 16 componentization. The rule states, each part of an item of PPE with a cost that is significant in relation to the total cost of the item shall be depreciated separately. Why? It fixes two massive problems. The depreciation lie. If you depreciate a 50 million airplane over 20 years, but the 10 million engines need replacing every 5 years, you're underreporting your expenses in years 1 to 5. You're lying to shareholders about how expensive it is to run the plane. The double counting trap. When you replace the engine in year 5, you capitalize the new engine. But if you did not separate the old engine initially, the cost of the old, dead engine is still sitting inside the cost of the plane. You'd be depreciating a ghost engine and a new engine at the same time. Here's my advice to keep your sanity. Materiality is your shield. Do not let your junior accountants componentize the office chairs. That's madness. Only use this for the big-ticket items, buildings, ships, aircraft, and massive industrial machinery.